Howdy, Jacob here. Today we're looking at Dexcom in the healthcare equipment and supplies industry. 27.9 billion market cap on 27.1 billion enterprise value. They focus on the design, development, and commercialization of continuous glucose monitoring systems in the United States and internationally. To my knowledge, the biggest competitors are going to be the Medtronic, possibly Boston Scientific, Insulet. Incorporated in 1999, so not as new, not as old as what I would have thought. Humongous revenue growth. I mean, this is absolutely out of this world. They've started to find their operating margin in the most recent 5 years, so that's awesome. Return on invested capital, very solid. I mean, a lot of things looking great here. Income statement does show over 10 to 15% of their revenue going towards research and development. That could be big. Again, R&D isn't guaranteed, but it is very likely, not very likely, depends on who's the types of things you're investing in, the the markets that they're in, the moat you might have, but it's usually a good sign for growth when you invest a lot in R&D, and it looks like that is definitely the case here. Their balance sheets has 2.2 billion short-term investments, 566 million in cash on hand. You're looking at about 2.7 billion cash-like products with no short-term debt and just 2.4 billion long-term debt. So we're not concerned with this balance sheet whatsoever. Their liquidity position is fantastic. Their CapEx has gone up quite a bit, but their cash from operations is significantly higher. So their production of free cash flow is immense, and their use of cash is really just share repurchases and reinvestments. Very small on the debt pay down, very small on the acquisitions, very heavy share repurchases and reinvestment. That might be enough for me to make my assumptions here. So on the revenue growth side, look at this year-over-year revenue growth. It is out of this world. And they're a $3.6 billion company already. I mean, I could say they grow 15% a year, probably deserve a pretty penny premium. Their margins have been a lot lower, but they're still trying to figure out how to make some money here. So maybe I'll do a little bit of a story here, 15 and 20%. They've had 25% once in the last 6 years from earnings and operating and free cash flow margin. But I think that's more than possible. Their share change, 1% for them is about 280 million. And I'm just going to say they offset stock-based compensation. Well, actually, 280, 380, 440, $440 million to share repurchases is quite a lot. So let's do 0.5%. And then again, you're investing a lot, reinvesting a lot of money as well. So it's about it's roughly 40-60 share repurchases and then 60% acquisition reinvestment. And we're saying it needs to fall 48%. Honestly, less than what I thought it would have been. But I am creating a story here. So 15% a year is definitely not nothing. It is a lot lower than what they've done historically. But again, the bigger you are, the harder it is to grow in almost all cases. And for margins, 15 to 20% is pretty high in comparison to their recent history. But again, they're reinvesting a lot. So I think that at the end of 7 years, this is more than reasonable. So for right now, I'm just going to wait. And I hope it gets to this price because I really want to do some more research and I really want to own a company that is growing this fast. Hope you enjoy the video and have a great day.